So here is Peter Lynch. He is best known for managing Fidelity Magellan Fund from 1977 to 1990, during which he achieved an average annual return of 29.2% under his leadership. The fund's asset grew from $18 million to over $14 billion. So in this video, we'll talk about the investment journey of Peter Lynch and what I and you can learn from him.
Well, you ought to find out why you bought a stock. If you're saying it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. You say, still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they're around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. I'll be able to write that down and follow that. That's what I do with the company. And that's your decision. That's how you sell it.
So Lynch began his career in Fidelity Investments in the year 1966 as an intern. And after a 2-year span in the US Army, he returned to Fidelity in 1969 and rose to become the Director of Research in 1974. And soon in few years, he was appointed manager of the then obscure Magellan Fund. So certainly this man generated a lot of wealth. So now let's look at some of his investment strategies that we can learn from. First, invest in what you know. See, he advocated in investing in companies whose product or services you understand and encounter in daily life. Second, conduct thorough research. Because while personal experiences can provide leads, Lynch emphasized the importance of fundamental analysis. So investors should delve into a company's financial health, earnings, growth, and market positions before committing their capital. Third is categorize stocks. Because Lynch introduced a system of classifying stocks into categories such as slow growers, stalwarts, fast growers, turnarounds, and asset plays. These categorizations help investors set realistic expectations and strategies for different types of companies. Fourth, long-term investment horizons. He believed in holding stocks for a long term, allowing companies to realize their full growth potential. Fifth is avoid timing the market. As Lynch stated that more money has been lost by investors preparing for corrections than in the corrections themselves. Sixth, growth at a reasonable price. He popularized the GARP investment strategy, which combines aspects of both growth and value investing. This approach involves seeking companies with strong earning growth potential that are traded at reasonable valuations. And last is PEG ratio. As Peter Lynch is also well known for popularizing the PEG ratio, that is price earnings to growth ratio, as a key metric for evaluating stock investments. This ratio is a valuation metric that helps investors determine if a stock is overvalued or undervalued based on its price to earning ratio adjusted for growth. So if you found this video informative, do subscribe because we post these kind of videos every week. And if you have any questions related to finance, you can contact on this number. We have a team of certified wealth advisors who can help you achieve your financial goals. And for more finance content, you can watch these.